Hi everyone, thank you for joining us for today's webinar on Industry Accounting Update, Private Higher Education. For those of you joining us who'd like a copy of the slide deck, as you'll see noted, you'll receive an email from me within 48 hours of the webinar with a link to the slide deck and the recording of the webinar. But first up, let me go through a few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter those questions. Just type them in and click submit. Our presenters will take some time at the end of the webinar or perhaps during to answer those as relevant. Next up are your audio settings. If you're using a telephone, please click on the phone call option. If you're listening through your computer, then please click on the computer audio option. Now let's go over some quick CPE requirements. To qualify for CPE, you must use a personal computer, no smartphones, and be logged in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame, actively respond to at least 75% of the polling questions there are 4, which means you will need to answer 3, and you must complete the evaluation survey at the end of the webinar. Now a quick intro to our presenters. First up is Dean Quiambo, partner with Armanino. He's been with us for more than 12 years, Dean. Started as an auditor and then transitioned to our chief relationship builder. He helps numerous nonprofits and private schools address their tax, audit, and outsourced accounting needs. He works with the private schools on the NBOA side as well as some of our folks on the WACUBO and NACUBO side. Next up is Stacy Kowalczyk, audit partner and partner in charge of our higher education practice. She's more than 14 years of audit and accounting experience focused on serving nonprofit entities including community-based social services, religious orgs, and obviously private colleges and universities. Finally, we have Katie Brown, tax manager with Armanino, 12 years of tax experience dedicated to the nonprofit tax team, serving clients in the higher ed, health, and social services space, Master of Science in Taxation, and just a general good person. I'm not going to lie. Learning objectives for today. During the webinar, we'll review the latest accounting standard updates, including FASB reporting standards and uniform guidance. We'll outline a roadmap for the practical implementation of these new standards and discuss current trends and issues related to private college and university reporting. And with that, I will turn it over to Stacy.
Thanks, Debbie. So we're going to start out the first part of the webinar today going over a few new standards. The first one that we're going to go over, the nonprofit reporting model, I'm sure all of you on the webinar have heard about for the past couple of years. So we're just going to kind of hit some of the high points today and then maybe go over some implementation examples. And then I'll go over some key facts about the revenue recognition standard, a new lease standard governing the treatment and the accounting for leases, and then a going concern standard, because although those are a couple of those are a little bit further off in terms of implementation, they're still going to have impact in the higher education world. So we wanted to just touch base on those with you today as well. And then we'll have a little bit of an industry update at the end of the presentation that'll go into a couple of other items that are important in the higher ed space. All right, so with that, I'm going to start out going over a little bit of the nonprofit reporting model standard. There's essentially 5 key components to it. Those are noted on the left-hand part of the slide up here that's up on the screen for you. Liquidity is probably one of the key elements of the new reporting model standard. It centers around a significant amount of additional qualitative and quantitative disclosures that are not currently required in the current GAAP guidance. So we'll talk a little bit more about that, give you some examples. We'll also go over a presentation regarding functional expenses, some disclosures and changes regarding net assets, cash flow options, as you now have the option to do either a direct or an indirect presentation, and then we'll talk about some changes to how institutions should report restrictions on long-lived assets. Just to let you all know, over on the right-hand side of this slide, a couple of key points when thinking about implementation for this reporting standard. It is effective for fiscal years beginning after December 15th of 2017. So for those of you that are possibly calendar year ends, that's going to be your 12/31/18 year end. Those of you that are June 30th, it's going to be 6/30/19 for you. It is a retrospective application back to the earliest period presented, so just keep in mind that if you present comparative financial statements, you're going to have to go back to the earliest comparative period presented when implementing and adopting the standard. A couple of caveats there. The changes for the disclosures for liquidity and the functional expense presentation. If you're choosing to present comparative financial statements, you have the choice per the standard to just do those disclosures and presentation items in the year of adoption. You wouldn't have to go back and do a comparative disclosure, for example, for liquidity. When we get to the net asset section, we'll talk a little bit more through this, but if you have any restatements at the beginning of the earliest period presented for the change in accounting principle for the changes in the net assets, you're going to make sure that that is appropriately disclosed and presented in your financials as well. And then the 5 key components of the standard, you have, as an institution, you can early adopt the standard. You can choose to do that prior to the effective date that I mentioned, but if you do, you have to do it on a full standard basis. We get that question a lot, can institutions out there choose to, delay the liquidity or delay the net asset presentation, but you really have to adopt the standard as a whole. You can't pick and choose the parts.
Well, and Stacy, that brings up a great point with regards to early adoption. Okay, so now we have to do the whole thing if we're going to do it, but are you seeing a lot of higher ed institutions out there seriously considering this, and what are your thoughts on that?
Yeah, we have heard from a lot of our clients and prospects and constituents out there about early implementing it, and our general guidance is that these standards haven't been overhauled for about 24 years or so, and so this is really a chance for education institutions and nonprofits as a whole to make sure that they adopt this standard soundly and put their financial statements in the best possible light. So our recommendation and what we're encouraging our community to do out there is to go through the process these next year and a half, 2 years, and make sure that you're ready for full implementation at the implementation date.
All right, so essentially do it at implementation date, not early adopt.
Not early adopt. Don't rush into it.
Right, as everyone said, you don't want to be the first one out there, right, Stacy? All right.
All right, so we're going to talk a little bit about liquidity first here, because as I mentioned, this is a part of this reporting standard that is new. Previously, nonprofit financial statements and those of institutions of higher education did not have to include any disclosures in their financial statements regarding liquidity. The one thing that I've always told my clients and prospects in this space is that you can liken this liquidity requirement to what we see in the for-profit world, similar to a management's discussion and analysis. Even if you were to look at a public institution's financial statements that are on a GASB reporting, you would see something similar in their management discussion and analysis.
This just sounds like lots and lots of transparency right here.
Exactly. Exactly, and it's really, the question that Dean brought up before and what I mentioned before is that this is going to allow your reader and your users to look at your financial statements and really understand how your institution manages its cash flow and manages its assets in an effort for the institution to be able to pay its obligations within 1 year from essentially your statement of financial position date or your balance sheet date. So that's really what it's all about. I know that there's been some concerns that have been expressed to me about, well, can these liquidity disclosures hurt me? What if we do have cash flow issues?
Absolutely.
And how is that going to, now reflect on my constituents and my donors and, debt holders or things of the like? And really, it's an opportunity. Also, I've told my clients it's an opportunity for you to also take credit for the things that you're doing at your institution to address some of those issues too, to address cash flow, to address enrollment and maintenance costs on buildings and everything that goes into how you're managing cash flow and liquidity. Okay, so let's look into what some of the required disclosures are, both qualitative and quantitative aspects of these disclosures, so keep that in mind. One of the key things here, that first bullet point, is you're going to want to include a description about the assets of your institution on your financial statements that do have a limited use. So for example, if you have assets that are tied to borrowing arrangements, so maybe you have like collateralized accounts or you have accounts that are set aside for debt service requirements, those are certainly things that you're going to want to include in your financial statements disclosures that have limitations. Additionally, if you have limitations on assets like cash and cash equivalents or, for example, pledges receivable that have donor restrictions, and they aren't available for that immediate use within 1 year from the financial statements, you're going to want to include that in your disclosures as well. You should also disclose if you have any other limitations resulting from contractual agreements. That's going to be key here also because, again, there's going to be lockups or other restrictions where those assets aren't available to pay for obligations of the institution. When you, kind of internally, again, back to Dean's point earlier, when you're looking at, any potential changes to your chart of accounts internally, just in terms of being able to track better some of the accounts and or the specific aspects of these items in order to be able to present these disclosures correctly, just make sure that you have appropriate structure in place and that you really understand the obligations and the limitations on your assets.
Well, with that said, Stacy, I think one of the things that we should maybe touch upon here is the practical utility of this disclosure with regards to maybe two things. Number one, this year the market, it's still strong, but there could be years where we have underwater endowments, and how does that affect this disclosure particularly? And then number two, I would say, is with regards to endowment or investment composition. And we know, we have a good amount of higher ed organizations out there that have those level 3 investments that liquidity is tough. It could be in a liquid investment. How is that going to affect this, and maybe what kind of planning can people do?
Yeah, so definitely one of the key items is to understand the market, understand your particular endowments and your restricted gifts. The example that's up on the screen here in the liquidity disclosure is actually a really good segue into answering Dean's question. If you look at that third paragraph, sort of the larger paragraph here on the slide, it includes some information for this particular institutional example, that talks about certain restrictions on investment funds that are subject to lockup restrictions. So those are where maybe there's redemption restrictions on those investments. So maybe they're in assets that are not readily marketable. There's a lockup time period. If you also have invested assets that are related to your endowments or your other restricted gifts that you're not going to be able to redeem at the fair value, you're going to want to make sure that information is captured in this footnote disclosure too. Because again, that gives that overall position of liquidity and transparency to the user. Additionally, if you have quasi-endowments, so those are typically board-designated endowments, you're going to want to put into your footnote disclosure what your institution is planning to do with those funds. So maybe you have a set aside there for capital improvements or to provide scholarships. But ultimately, at the end of the day, if a creditor were to come calling, or there was some other aspect about your operations where you needed to be liquid, those quasi-endowments or those board endowments would be subject, to any creditor obligations if they're not otherwise restricted or collateralized. Additionally, the first part of Dean's question, any type of spending rate that you have on your endowment assets that directly correlates to your investments and the return on those investments. I get the question all the time, well, what happens, when the auditor's in and they're finishing up the audit and there's this time lag, between when the audit is issued and that time frame, that horizon that you're supposed to look forward to, as to when you can meet obligations. Does it become irrelevant? Does the utility diminish? And, what we've said there is that if you have a means to, monitor the market, to, understand how the value of your investments is going to change and how that's going to impact some of these assets, put that information in your footnote disclosure. You may not have all of the concrete and the cut and dry answers, but the more that you can, put the general disclosure in the financial statements, the more transparency and utility it's going to provide for the user.
Very good. Thank you, Stacy. That was very insightful.
On the next slide over, just to finish up with this disclosure example, you're going to want to, as I mentioned before, you're going to want to include some quantitative disclosures also. So your quantitative disclosures could be, simple like the example that's up here in a tabular or reconciliation format that just really backs up those particular assets from the statement of financial position that are available and support the footnote disclosure. So here you can see some of the things that we talked about, the short-term investments, the long-term investments that have been appropriated for use, and the piece of the cash that's available to support operations. Again, if you have any issues with collectability on your pledges, those of you that are nonprofit institutions, you have no doubt significant contributions receivable, and if there's any valuation or collection issues on those, you're going to want to make sure that that's a key component of this disclosure as well.
Perfect. And now we're going to enter into our first polling question. Again, those here for CPE, you need to answer 3 of the 4, so make sure you get this one in. First question is, do you believe the liquidity disclosures will provide transparency and utility to users of your institution's financial statements? A, yes, B, no, or C, undecided, not quite sure yet. Get those answers in. And again, for those of you who are going to want a recording of this webinar or the slide deck, I'll be sending those out within 2 days of the webinar. And we'll close the polls here in 3, 2, and 1. It looks like 87% think there will be added transparency.
Well, that's good. That's good to hear. I know when the standard first came out, there was a lot of folks out there just really worried about it, maybe losing a little bit of sleep overnight about that particular disclosure. So it's nice to see that result there. All right, so we're going to move on to the next topic in this standard, which is some of the changes required for net asset presentation. So I want to, just a 10,000-foot level introduce this section. The main changes here is providing transparency and consistency across all nonprofit organizations, not just those of higher education, but also, any social service or any other sub-industries within nonprofit. It's going to, really the changes here are directed at eliminating the distinction between the resources that are now under current GAAP, considered either permanent or temporarily restricted on the face of the financial statements. Rationale for that was that distinction would help to, again, provide transparency, but eliminate some of the confusion out there from the users that are reading through the financial statements. Another key element here to keep in mind as we talk through some of these changes, part of our recommendation to our clients and our community and our constituents out there is don't change your internal chart of accounts. So you've already got your chart of accounts set up to track your unrestricted, temp, and permanently restricted. You're still going to want to have transparency internally on the distinction between those restrictions. The way we're packaging this is that really it's for an external roll-up presentation on your external financial statements that then goes out to your donors and your creditors and the other users of the financial statements. If you have to spend some time over the next year and a half, 2 years before implementation to do some work on your chart of accounts, to make sure that you're capturing the requirements of the new standard here accurately and effectively, then again, take the time to do that because that's more important than, jumping into full implementation.
And just to reiterate that, Stacy, so you're saying don't come up with a new chart of accounts, but maybe remap it and, get efficient that way.
Remap it, enhance it, and make sure that you also understand your restrictions in depth on your awards.
Okay, so no recreation of the wheel.
Recreation.
All right, let's do it.
I got concerned from that one a lot too. Okay, all right, so just to give you a couple of examples here on the next 2 slides. So this is an example statement of financial position for an education institution. This particular statement is classified. I know a lot of you out there do not present a classified where it breaks out assets and liabilities between current and long-term. I do have institution clients that present a classified balance sheet. The majority of you guys I know are presenting non-classified, so those are small distinctions. Just keep that in mind. You're going to want to draw your attention down to the bottom of this particular statement. The key change here is the net asset section. So those net assets with and without donor restrictions. Remember, the net assets with donor restrictions is going to include what is now called your current temp and permanently restricted net assets. Similarly, on the example statement of activities that's up here on the screen in front of you, again, going from that 3-column presentation down to the 2-column approach. I would also encourage you all out there, although it's not shown in this example, part of the initial standard was a proposal to present a measure of operations. So basically a separation from the operational activities between the non-operating activities of the institution and all nonprofits. You should feel free to make that distinction in your financial statements as well. I do have some clients that do that. It didn't make its way into the final standard. It's still pending approval and possible future standards. But if that helps also to break up your financials and present a more transparent and fuller picture, then certainly talk to your finance team, your management team, board audit committee, and your auditors about that. Okay. All right, so let's talk a little bit about some disclosures that go with these changes in the net assets. A couple of things to keep in mind here. If you want to go to the next slide. Action items. So identify, whether your institution has internal designations on net assets. So all of you know, I'm sure, and you're aware of that right now in your financials under current GAAP, you're required to present a lot of information about external donor restricted endowments and also donor restricted, temporarily restricted net assets. Okay, so that's a requirement under current GAAP. Now some of you I know are presenting similar information about your internal designations or your board designated endowments, but not all of you. So one thing that's interesting is that this standard, the change in this part of the standard, is now going to require you to implement some of those same types of disclosures for your internal designations, for your board designated net assets, for your board designated endowment type of assets. So make sure, again, over the next year and a half that you identify whether you have these types of assets that you have internal designations on. Or if you're an institution, one of the rare ones that doesn't have any internal designations currently, but you're thinking about doing that. You're thinking about setting up a capital project fund, a scholarship fund, reserve fund, contingency fund, whatever it may be. So try to think, about and incorporate how those future actions are going to impact implementation of this new standard too. Boards, the boards of your institutions, for all of you on the line this morning, they can certainly delegate the authority under the new standard for management to determine some of these internal designations and what kind of funds you want to set aside. So keep that in mind when you're planning for this as well.
And Stacy, what about the organizations out there that already kind of have these designations or already disclose these types of designations? What are your recommendations to them? Or have you seen that yet?
Yeah, so I do have several institutions that have reserves currently internally, and I think that, a lot of them do a great job, at disclosing what they're going to be used for. I think one of the things to keep in mind here is really make sure you also link your internal designations to your liquidity footnote, right? Because the two in the new standard and the new requirement go hand in hand. And so that would just be the additional guidance I would give.
Yeah, that sounds like a really good best practice, increased transparency and, using, all the strategic initiatives of the organization to its benefit. I mean, that's kind of, as a reader of a financial, that's how I would read that and see that.
Exactly.
Okay.
And it makes a difference from the external perspective from donors and, other potential funders as a nonprofit institution.
Thanks, Stacy. Now we're up to our second polling question. Again, for CPE, you need to answer 3 of the 4. Question is, do you currently disclose information about internal designations similar to the new requirements? A, yes, B, no, or C, my institution does not have designations on net assets. We're looking somewhat evenly split here as we get those answers in.
I should have asked if your institution plans to have designations on net assets.
There you go. Type those answers in right now. But get the actual polling question in. We'll close in 3, 2, and 1. Looks about like half are saying they currently do.
Mm-hmm. Great. Well, those of you that don't, let's talk. Okay. All right. So let's move into the second part of our disclosure example here is for the net assets. Talk a little bit about net assets with donor restrictions. So the next couple of slides are example disclosures for reporting some additional depth to your net assets with donor restrictions. So again, you know, a lot of you are used to including in your financial statements a footnote disclosure, you know, that says, hey, we've got all these temporarily restricted reserves. You know, they're restricted for scholarships, they're restricted for capital purchases, so on and so forth. So really, that hasn't changed. That really hasn't changed too much. What you see here on this slide in front of you is just a little bit more disaggregation, if you will, behind those numbers. So one of the things you're going to want to make sure that you break out is the specific purposes for those particular restricted items, and then the whether or not you've got any that are restricted because there's a passage of time issue there if you're still waiting to receive the cash funds on those gifts, or if they're for a future period. And then you're also going to want to list out your net assets that are subject to your school's spending policy and appropriation for expenditure. So those assets are primarily going to link back to your spending policy on your endowments, both your external donor restricted and your internal board designated endowments. So that's at the bottom of the screen here. So again, you know, not much change there, but just a little bit more storytelling, if you will, on what those assets are actually restricted for and time periods. Similarly with the release footnote, again, you're going to want to include similar information about the purpose restriction that's been accomplished, any time restrictions that have been passed, and then again, subject to your appropriation policy on your endowments, those net assets that have been released because of the appropriation policy. Couple of additional add-ons to our endowment disclosures in a little bit more of a qualitative format. Your board now has a disclosure in the financial statements on their interpretation of the MIFA law, which is basically the state law for the management and investment of endowments. So now your institution is going to have to take that one step further, and your board's going to have to disclose their interpretation of their ability to spend from their underwater endowments. So we talked a little bit before, you know, Dean brought up before just about some of the changes in the market. You know, the market's not been doing as great, you know, the past couple of years, and we'll see where that goes. And your institution, you know, has a spending policy. So how is all of that going to impact your ability to spend according to that policy that you've set out for your funds? One other significant change there, second bullet point, currently, if you are an institution that has underwater endowment funds, you're reporting that piece of the underwater fund in your unrestricted net assets, right? Hopefully all of you are. So,
let's hope so.
So under the new standard, those underwater components of your endowment funds are now going to be reported in that column that's those net assets with restrictions. So that's the big change there. And really for a lot of you, when I mentioned before at the beginning of the presentation, if you have any prior period restatements as a result of the adoption of this standard, that's where you're going to see it, because you're moving it from one classification to the next, which is going to result in that prior period issue. So we had a question on what an underwater endowment fund was, so I just want to take a second to answer that. An underwater endowment fund is basically when a donor gives you, let's say a donor gives you $1 million, that's the corpus, and then you invest that, market's not doing so hot, and now the value, the invested value of those assets is only worth $800,000. That underwater piece is the delta, the $200,000, the difference between the original corpus gifted by the donor and the fair value, if you will, of the invested assets tied to that donation. Keep in mind on the third bullet point here that you'll want to, your spending policy needs to also include specifics on your continued appropriations, sort of in line with my first bullet point from those underwater endowments. And then just one other change on your investment return. If you were used to breaking that out before between the interest and the change in value, those components, you don't need to do that anymore. You can aggregate that all and have it be in one line item in that footnote disclosure.
You would still need to track the difference, certainly.
Exactly.
Because your tax people will be asking you. For
my trusty tax advisor over here wants to make sure that you all still track that internally, or else she'll be bugging you. She'll be bugging me too.
Everyone.
So just a couple quick disclosure examples on this next slide here, showing you the breakout of your internal designated and external restricted endowment funds with and without donor restrictions in the new presentation format. And then on the next slide, as I mentioned, with these bullet points, tabular disclosure of the components of the endowment change, both those that are external and internally restricted. You're the footnote disclosures that I mentioned before that are qualitative narrative format, for example, the board's interpretation of the law, and then the additional disclosures about the spending policy and the ability to spend, so on and so forth. That information can all still be presented in narrative qualitative format in the financials. All right. So that was 10,000 foot level of net assets. So we're going to go into our functional expenses next. So key thing here with the functional expense changes, so many of you, I know many of my clients and many of you out there are reporting expenses by their functional breakouts in your statement of activities. The new standard here is going to require all nonprofit organizations, whether you're an institution or another type of nonprofit, to now record expenses by both their functional and their natural classification. And the interesting thing I thought when I read the standard is that it said you have 3 choices of where you're going to put that information. It has to be all in the same place, both by nature and function, but you have 3 options. So you can either choose a separate statement of functional and natural expenses. You can do it within your statement of activities, or you can do it in a footnote disclosure. We recommend that you don't do it in the statement of activities just for the main purpose that it would make that statement very, very cluttered and muddied. Our recommendation is that you do a separate statement or you do a footnote disclosure. I particularly like the footnote disclosure. I already have a couple of clients that have early adopted this standard because it's not, I shouldn't say that, the presentation is not prohibited from current GAAP. So I have some clients that are already presenting a footnote disclosure that includes a breakout of both natural and functional expenses. And so they're well on their way to implementing it. And I think it's a really clean presentation. So, I'd encourage you again to talk internally, talk to your board, talk to your auditors about what you want to do there. Similar to what we talked about on the net assets and some of the other topics we've had so far, look at your chart of accounts and your setup by department. You're going to want to make sure that, if you need to make changes to your chart of accounts to track, the functional and the natural classifications, for example, making sure that like faculty salaries are separate from management, that you have a good topside allocation approach, that all of those things are built into your chart of accounts and into your policy, your expense classification policy.
Stacy, I'm glad you said that. It seems like a lot of this is really financial statement presentation purposes. It's not like, big changes in how we're going to account for things, but really a presentation. And so when you say chart of accounts, when you say mapping, when you say all of those things, is your chart of accounts, is your operating system, accounting system going to allow you to make all of these reporting changes? Or are you going to be scrambling in the year of adoption saying, oh no, how am I going to gather this data? What we don't want, and we never want for an audit, is to be asking for reports that we get created once a year just for the audit.
Exactly. And I should have asked you all how many of your systems are capable of tracking your allocations already. Because I know that, some institutions have been worried that, they're so manual already. And it's going to be even more manual. So again, something to take a hold of now and start implementing changes necessary. One thing here that's going to be a difference from audit and tax is investment expenses should be netted with investment return. So for book purposes and financial statement presentation, those aren't included as part of the functional classification. So for tax, I think that still needs to be the opposite.
Right. We do break out the investment expenses and move them from revenue to expense for tax. And as we were talking about just a minute ago too, on the investment income side, we separate out, the interest and dividends versus realized gain and unrealized gains. So even though it's being shown all together on the financial statements, readers of the 990 will see the breakout between the different types of investment income. And there will be an adjustment from audit to tax to show that the investment expenses are going to be included with functional expenses on the 990.
Awesome. All right, so let's go to the next slide actually and look at an example of what a footnote disclosure would look like that I mentioned before. So this is actually similar to what some of my current institution clients are doing. I think this is really clean. One of the questions that's come up a lot is, well, we have to present the natural classification too. Well, how do we know what to present? Like, how in-depth do we need to go? Like, how many categories of natural expenses do we need to present? It's interesting that the standard itself did not give concrete recommendations or guidance on that. But the one thing that it did stress was for any nonprofit, including institutions of higher education, to really sit down and determine which natural categories of expenditures are providing, most of the return on the program or the mission of the institution or of the organization. And so for most of you, that's going to be your salaries, your salary costs for instruction and support. It could be things like interest, depreciation, professional service fees, things of the like. So that's going to be different. There are going to be differences there from institution to institution. So we'd encourage you to take a look at that internally and with your auditors as well. And then also, have a policy that we mentioned before for allocation. For example, if it's either based on square footage or some other applicable allocation methodology for overhead costs. Okay, statement of cash flows. A couple of quick notes here. This section will be really quick. Basically, the 10,000-foot level of the standard is that you have an option now to present either a direct or an indirect method of cash flow presentation. Currently, what 99% of you do present is an indirect method. So that's basically where you have the reconciliation of the operating section of cash flows. We, we've done some polling out there. We've talked to a couple of our clients and other prospects, and our recommendation is that you continue with the indirect approach. It's generally overall less difficult to prepare, so that internally means that it's less costly for you as an institution. We also anticipate that this method is going to continue to be the most widely accepted method for third parties, so any of your debt holders who are looking at your financial statements or other users.
What's funny about that? I don't think I've prepared a direct method of cash flow since college, intermediate accounting 2.
Yeah, I would have to agree with you. I think I've maybe prepared one, and it was a long time ago.
So I was wondering, do we have any clients, or are you seeing any organizations wanting to go that way?
Yeah, we do have, a lot of, I would have to say that we have a lot of, a significant amount of nonprofit clients as a whole, including some institutions that have asked about it because, You know, it's interesting for someone to read it, a direct cash flow, and see the ins and outs.
Right.
You know, so cash collections from tuition and cash collections from contributions and outflows for salaries and vendor costs and things of the like. But we still, you know, it's a very, very, very hard schedule to
Arduous.
Arduous.
That's funny.
Thanks, guys. And with that, we have I don't even know if I like this polling question anymore. Will your institution change to a direct method cash flow? A, yes, B, no, C, undecided, or D, not sure, which is basically the same thing. So, you know.
Or we could just put E,
Don't do it.
very arduous.
I think we've somewhat convinced most people, it looks like.
But, you know, I mean, that's a very good point, Stacy, that, you know, I have had CFOs say that I like it because it provides more transparency. So, yeah, good luck with that. But, yes, it does give more transparency.
Good deal. Get those answers in case you haven't answered. For CPE, you need to answer 3 of the 4. We'll close the polls here in 3, 2, and 1. Looks like about half are saying no, half are saying not sure. So maybe we'll have to do a little bit more convincing.
No is the right answer.
That's too funny.
Okay, we'll let you all decide. Okay, last quick section here in the nonprofit update has to deal with restrictions on long-lived assets. So, for example, if you've had a donor that's contributed a building, for example, there's an option in the current GAAP that you can release those restrictions over the useful life of that acquired asset. So the change here is that if you receive such an asset, if there's no donor restrictions, that you're going to utilize essentially this placed in service report approach for reporting the expirations, and essentially you'll record all of the releases once the asset is put in place. So again, this is part of the standard that could result in a prior period restatement if you've been using the current option that's in GAAP. And just keep that in mind. Okay, let's go through a couple of other accounting updates. The first one I want to go through is your financial responsibility ratios and your composite scores. So a question I get a lot from my clients is, well, with all of these changes that we just talked about to the financial statement presentation, that's no doubt going to have some impact on these composite score calculations, because we're not really comparing apples to apples anymore in the way of terminology and calculations. So, you know, we've done a little bit of research into that, and we've looked at, you know, what's out there, and what we've found so far is that the Department of Education has not yet proposed any changes to those composite score requirements, the reserve standards, you know, in terms of the calculation or the definitions. But this is something that, you know, we're going to want to pay attention to as it gets closer to the implementation time frame, because there no doubt may be changes that come before full implementation. The other thing, just, you know, that you're all aware of, most of you are probably aware of, there was a proposal, a ruling that came out in the, I shouldn't say ruling, a proposal that came out to restructure some of the Federal Register by the Department of Education last summer, so July of 16. There's a link to it on this slide. The link is actually to a response letter from this proposed ruling by NACUBO, which is the National College Business Officers Association. The proposed ruling was initially a new standard for determining whether a borrower has a defense to repayment on a loan for an act or omission that the institution has taken, but that particular proposal has kind of been expanded or elaborated upon a little bit, in the sense that the proposed rules are going to further alter the definition of when an institution is not considered financially responsible. And so there's certain triggering events, including you know, how claims and lawsuits outstanding could impact financial responsibility, you know, accrediting agency actions and other issues, for example, if an institution has to close down a program. So there's an interesting Response, again, there's a link there from NACUBO to that proposed ruling. I'd encourage all of you to take a look at that if you aren't already aware of it. Another new standard that's coming out is the going concern standard, and it, previously I think that the key thing here is that it's going to amend the GAAP guidance to include rules on management's responsibility for evaluating going concern considerations. So what's interesting is that previously this particular guidance was part of the audit standards, and it was on the auditor to determine whether or not there was going concern issues. So this is a major change. And I like to also, tell my institution clients that I think this particular standard is also going to go hand in hand somewhat with your liquidity standard if there are going concern issues. So you're going to want to, when you adopt this standard, you're going to want to look out at a time frame that's going to be 1 year from the date of issuance of the financial statements and determine if you have any issues that cause substantial doubt about your institution's ability to continue as a going concern. This is effective for fiscal years beginning after December 15th of 2016. So again, calendar years. You're going to have to do this for 12/31/17. Those of you that are 630s are 6/30/18. The revenue recognition standard, I wanted to bring this up here to my institution clients because there is applicability to you in the sense that the revenue recognition standard applies to nonprofit colleges and universities for your earned revenue sources. So that's going to be your tuition revenue and any of your other earned programmatic revenue streams. Initially, the standard was really a bridge between U.S. GAAP and the International Financial Reporting Standards, was going to have significant impact in the software world and sort of combining all those revenue recognition standards out there into one set of standards and a model that could be applied to several different industries. And as a result of that, it applies to certain streams of revenues and contracts with customers that, again, apply in the institution space. Now, with that said, because of the way institutions recognize revenue, based on your school cycle, on your education cycle, it's not going to impact you significantly in the way of having to restate any prior amounts recognized, but there will be some additional disclosures for your institutions in the future that you'll have to comply with under this model. Donor contributions, just one point here, those are the typical donor contributions are scoped out of the standard. This will be effective for fiscal years beginning after December 15th of 18. So again, 12/31/19 or 6/30/2020. All right, and one last accounting standard before we do our last polling question and turn it over to Katie. Lease accounting standards. So I'm sure most of you have heard about this, but you're now going to have to look at some of your operating leases. So you all know you have a disclosure in your financial statements for those of you that have operating leases for facilities, for example, any space that you're leasing to conduct your classes. Or for other purposes. You're going to have to look at those leases and determine the most likely lease term that you're going to take advantage of, so including any options to renew, extensions, things of the like. The new standard now requires institutions, nonprofit and for-profit entities to determine that lease term and then capitalize onto the balance sheet a right-of-use lease asset and liability. Really the impetus behind this is that many users, many constituents out there thought that both nonprofit and for-profit financial statements lacked transparency in the obligations under operating leases. So that's really the impetus behind this. We get a lot of questions here. Well, how does this new change? How is this going to affect if I go out for a loan, a line of credit, debt? We'd encourage you to talk to your specific banking institutions about this. We have heard from several of our banking institutions that they might look at something like this as sort of a second mortgage or a secondary lien or debt obligation. There are some that may not consider it as much if you're going out for financing. So you're going to want to definitely talk to them if this is going to have an impact on you. This is going to be effective for fiscal years beginning after 12/15/2019. So again, 12/31/2020 or 6/30/2021. On the next slide there, I've given you a little table that I think is important for both operating and financing leases that will kind of walk you through how the transaction is going to be recorded on your three main financial statements, including your statement of financial position or balance sheet, your income statement, statement of activities, and your cash flow statement. The transaction recording is going to be very similar to how you currently record capital leases, just that now you're going to have to also capitalize those operating leases on the face of your statements too.
Excellent. And now we'll get to our fourth and final polling question. Following up on Stacey's talk just now of lease accounting, how many long-term operating leases does your institution have? A, 0, B, 1 to 5, C, 6 to 10, D, more than 10, E, so many you're just not sure. Get those answers in, and we'll close the polls here in 3, 2, and 1. And it looks like kind of pretty much an even split amongst everything other than the more than 10. So nothing more than 10, or they're just not sure.
I think, Stacy, that what's going to be interesting there is, you know, when those lease agreements where somebody donates some property for a very minimal amount to the school, and how are we going to track that and capitalize that asset and potentially the, you know, capitalized contribution. That's going to get...
The right of use, lease, and liability.
That's going to be fun.
It's going to get complicated.
So if you have that, we should talk about that too as well.
I do have a couple institutions that have those. All right. Katie Brown.
All right. So people have asked if any of these accounting updates are going to have any tax implications, and the answer is not really. There haven't been any major changes to the 990 since 2008, and you know, our balance sheet will be reduced from 3 types of net assets to 2, and that's going to be about the extent of how these changes are going to affect the 990. But I always love the opportunity to remind our clients and our friends of the most important tax issues that they should be paying attention to. And so I've got 3 top items here for you. The first is unrelated business income. And there are, of course, a wide variety of sources of income that can generate UBI. One of the biggest ones that we're seeing right now are partnership investments that issue K-1s. They've started getting a lot more detailed in terms of allocating unrelated business income that's being passed through from specific states. So we're seeing in the footnotes of a lot of K-1s some really detailed state reporting issues. And once you begin filing in a state, you have to usually continue filing in that state. They start asking for, you know, you filed last year, where's your return for this year? So it's something to be sensitive to, that once you start filing in a state, you're going to have to keep filing until you let them know that you're no longer receiving revenue from them. Another issue that is often noted in K-1 footnotes is foreign filings that can be required because, as you know, as a partner in a partnership, everything that partnership does for tax purposes, it's as if you did a piece of it yourself. So if there's a transfer of cash to a foreign corporation that's over $100,000, or just a wide variety of things that can happen that will be disclosed in those K-1 footnotes and that your tax folks really need to know about. So if you receive K-1s, if you have new investments, please be sure to let us know and give us copies of those K-1s so we can make sure that we're reporting everything that's required. Another issue that we see in UBI is debt leveraged investment income. So if you're using any sort of debt to purchase partnership interests or other securities, the debt leveraged portion of that is taxable to you, so you'll want to watch out for that. Another is rental of tangible personal property. So if you're renting out space and there's a separate charge for chairs or tables or linens or anything like that, that rental income is per se unrelated business income and must be reported and tax paid on it. And then also, if you've got a rental contract that includes any specific services, that taints the rental income to UBI also. So if you're providing specific security services for an event, or if you are doing the catering with your own catering department or your own food and housing department, those types of things will be considered UBI also. So if you have anything like that, please just let us know. The second big issue that is always big when the financing happens, but then it's very easy to forget about afterwards, is tax-exempt bond financing. Two major issues that we see a lot are, one, there are strict limitations on private business use, and that means use to generate income by anyone other than the institution who received the tax-exempt bond financing. So even if you've got a contract with another nonprofit to use part of the facility that is financed by tax-exempt bonds, that can be considered both private business use, and it can jeopardize the tax-exempt nature of the bond if there's too much of it, and it can also generate unrelated business income. So you want to look at any contracts that you have with nonprofits if you've got tax-exempt bond finance facilities. And there are a couple other things that we can talk about that can help with limiting exposure, such as using equity allocations. The portion that is of the building that is not financed by bonds can be allocated to the area that you've got the contract with the external party in. So there are some things you can do there, and then there are safe harbor exceptions for several basically arm's length type management contracts. So if you've got all of your food services being done by one company and they're operating inside of your financed facilities, if you meet all of the exceptions, there are safe harbors available. And the one other item on tax-exempt bonds is that if you have any of the proceeds from the bond financing invested, you have to look at it every 5 years to see if you've earned more interest than the rate of the bond. And if you did, you have to make a payment back to the government. This is called arbitrage, and your bond counsel should know about it, but you do have a requirement every 5 years to look at it if you had any reserve funds invested from the original bond financing. And the third one we always like to remind everybody of is executive compensation and benefits. So there are some benefits that we can provide to executives on a tax-free basis to them, and then others that it's easy to make a mistake and all of a sudden they're taxable. So one of those items is on-campus housing provided under Section 119. If it is on campus and it is part of the employment contract and it is a requirement of the person's employment, then you're looking at non-taxable. But if it's not on campus or if it's just a benefit, then we're looking at taxable. So we can help analyze any of those situations if you've got that going on. And then also there's certain issues with faculty housing at less than market rate, where they would have to recognize income for the amount that is below fair market value. So if you've got special rates for faculty housing, just let us know and we can have a look and make sure everything's correct. And then tuition remission is another big one that everybody gets excited about, but it has to be, in order to be non-taxable, it has to be non-discriminatory, which means that it doesn't skew in favor of executive employees. So as long as it's available to not only executive employees, it can be a non-taxable benefit. And there are a lot of others out there too. So if you've got questions about what types of benefits are taxable to your employees, what types of executive compensation packages, what they should include, or wording, or any sort of assistance we can provide, we're happy to do that. That's it for tax.
All right. Thanks,
Right
Katie.
on time.
Right on time. So we have just a couple of other slides. I just do want to take the last minute or so that we have in the webinar and just touch upon one of those slides, which is centered on governance, risk, and compliance. So many of you, I'm sure, no doubt aware that, enterprise risk management and cybersecurity have become really hot topics lately, not only in for-profit entities, but also nonprofits and institutions of higher education. Colleges and universities are also particularly popular targets because of the multiple networks of users that you institutions have out there, and then students have a handle in that also if they're online and they're doing anything risky online. And really our point here is for the institution to analyze enterprise-wise your appetite for risk. And that extends to financial, operational, and technology. And then cybersecurity is part of that as well. That includes looking at all of your insurance policies and things of the like and making sure that you're covered for those particular types of instances. That's something that we see a lot is the coverage in that space is lacking. I read a statistic that the average cost for a smaller institution is about $38,000 in dealing with cybersecurity, so that's not insignificant. So just wanted to put those couple of things on the screen there for you. The last couple of things that we have in the slide that we won't go over in detail today are just some information that's published by NACULO on tuition discounting and the Common Fund study of endowments. I wanted to include some of these metrics in the slides because they are important trends for you to track. They're also important trends for you to track in the way of implementing some of these standards, especially when we talk about liquidity and endowments and things of the like.
Perfect. Thank you, Stacy, Dean, and Katie. During today's webinar, quick review, we've looked at the latest accounting standard updates, outlined a roadmap for practical implementation, and we touched briefly on some current trends. When I send out the slide deck and recording over the next day or so, you'll be able to kind of look through those slides a little bit more in depth. If you've got any questions, please don't hesitate to reach out to Stacy, Katie, and hope to see you at an upcoming webinar. Thanks so much all, and have a great rest of your day.